Hey guys, so I was a bit curious about this myself. I wanted to know which concept within SMC do the beginners and unprofitable traders who trade SMC struggle with the most. So I posted this small question in our GPSFX Telegram channel. If you haven't joined this here, the link is in the description. So the question goes by this: which technical concept in SMC do you find the hardest to learn or understand, or you have completely no idea about? So this was the question, and we had options like market structure, entry models, all these things, and people seem to have voted the most for market structure and liquidity. So it's fine, it's completely fine. I will tell you guys A to Z about all these concepts. But before we look at these things, I want you guys to go to our YouTube playlist and watch the videos we put under market structure and liquidity, because you will get a lot of value from there. In this video, I will make this video a sort of the first and last video you will watch regarding SMC. So those kind of videos. So this video will be the first and last video you watch regarding liquidity, because these are all actually basic concepts, right? We can look at other advanced concepts like different entry models, adapting to the markets. So we can look at all those things in our later videos. So I will make 6 videos one by one, from liquidity to all these other options. So what I want you guys to do is first watch everything in our YouTube playlist, get some understanding, you'll get a lot of value. Then you can come and watch these videos. Okay, so in this video we'll look at liquidity. So make sure to put all your attention from the start till the end. I will share everything you will need to know about liquidity in SMC. So let's get to the markets. All right, people. So first we begin. I want you guys to know that I won't be editing this video too much, because this will be most like a lecture. I can't make this entire concept of liquidity in SMC into a single video. So this will feel like a lecture, but that's completely fine. Just pay attention from the start till the end, right? Okay, so we'll be discussing every single thing about liquidity in SMC, A to Z. Let's get into the topic. All right. So the first question I want to ask you guys is, when I ask someone, let's say a beginner or an unprofitable trader, what do you think about liquidity in SMC? What will be their answer? Usually their answer will be like this: double bottom, double top, triple top, right? This is the only answer that you'll get most of the time when you ask someone about liquidity. But the truth is, for every single movement that happens in the market, for every single time the market moves from point A to point B, the only reason that's happening is liquidity is acting behind that. Okay, so get this into your understanding. Liquidity is the only reason the market moves from point A to point B. So when you call something as an order block, you can call something as a fair value gap, you can call something as an imbalance, or let's say even breakout structure, right? What are all these things? They are all nothing but liquidity. We are just labeling these things with different names in order to understand and analyze the market. So for every single moment, every time in the market, liquidity is the only force behind that. Okay, so this is a fundamental basic knowledge you should have about liquidity. Ingrain this into your understanding. Liquidity is present every single point in the market. Okay, so now let's look at this structure. I'll be showing to you guys multiple scenarios on how you should approach liquidity when it happens in the market, okay? So if you see in the structure, we got a strong and valid breakout structure right here. Don't question this. This is a valid and strong breakout structure. So the previous structure might have been like this, but we don't really care. So which point is the swing low? It's this point, right? So this point is the swing low, and this point is the swing high. So this is the range where we will be looking for trades in any structures, right? Okay, so what will you take off this tiny pullback you see right here and the same one right here? So are these also breakout structures that's happening in the market? The answer is obviously no. So what's the reason? Why are we as traders considering that this is a valid and strong breakout structure, but we are not considering these two breaks as a valid and strong breakout structure? The answer is very simple. So usually when we get a valid breakout structure and the swing low has been decided, we do one simple thing. We take out our Fibonacci, we put that from the bottom of the swing low, which has been confirmed, and we put it to the top of the structure which has not been confirmed as the swing high. So in this case, we just assume that this is the swing high. So we just put this fib here. If you see, we don't get 0.5 retracement level. So this is obviously not a strong breakout structure. So you should not be considering this as this. Okay, so we have only one valid breakout structure. So now comes the interesting question. If these two are not breakout structures, what are these two? The simple answer is they are simply minor pullback that happens within the strong swing high and the swing low. Okay, so these things are just insignificant minor pullbacks. So to answer this other way, these are all nothing but liquidity that the market accumulates in order to use them in the future. So when we draw a line from the swing high, you can see this is the left side and this is the right side. So we have two types of liquidity, the liquidity that gets accumulated in the left side and the liquidity that we will be expecting to get accumulated in the right side. Okay, so in this scenario that I have drawn, we only have liquidity present in the left side, right? So these two are nothing to be complicated, they are just liquidity. So let me just mark them that the liquidity is behind these two structures. Okay, so now we know that these two are liquidity. So now how should we approach this entire structure? How should we look between this swing high and this swing low? That's the question. Okay, so when the market comes down, we have already marked our point of interest, which is nothing but our order block. So in this structure, we have marked about 3 order blocks. I usually say that there are only 2 valid and strong order blocks in every single structure, no matter where, no matter which time frame. Usually there are only 2 strong order blocks, right? But in this case, we have marked 3 order blocks, but this is completely fine. We will be able to filter any order blocks that happens more than 2 into just 2 order blocks, right? So even when we get 3 order blocks, we can just filter and use the only 2 strong order blocks. Okay. So now what we need to do, we know this is the point where we get a strong BOS. This is the swing low that has been confirmed after this BOS, and this is the swing high. So we got everything in place. We know this liquidity. We know where our order blocks are, right? So now what should we do? Take out your fibs. Now mark your fib from the bottom, which is the swing low, to the swing high. Okay. So if you see here, this is the 0.5 retracement level. You should always use the 0.5 retracement Fibonacci level because that's the standard for pullbacks, right? So sometimes the market can pull back right here. Sometimes the market can pull back just right here, right? So the 0.5 level is kind of an average. So you should always use this in every single structure you trade, okay? So this is the 0.5 level. Let's just make this a bit smaller. All right, so now we are done. We are set for trading this structure. So now what should we do? We have marked our order block right here. So when the market comes to this order block, what should be our first question? Whether the market has hunted liquidity within this structure. The answer is no, because the liquidity is present here and here, right? So still the liquidity has not been hunted. So when you want to trade in this order block, all you have to do is you can use different entry methods, but I don't really recommend it for the beginners. So what I would say is just use low risk. Okay. So you can, instead of using 1%, you can use like 0.3% per trade when you're trading in these kinds of order blocks. Okay. So just reduce the risk, very low percentage of risk. I'll just write this down here, 0.3, because, and the reason is, this is the important part. You should know the reason why we are doing this, because the liquidity is still present in this structure. So let's say the market comes down. Obviously, the chance that this OB fails is very, very high. So we will be expecting that actually. So when this order block fails and taps into this order block, now the market has already taken some liquidity towards the left side, right? So this does nothing but increases the probability that the market will once again go up. This is the simple way of understanding liquidity. The more the market hunts the liquidity present towards the left side, the higher the chance that the market will shift its choke and move up, right? Okay. So when the market taps here, even though this has already taken this liquidity, there's still one more structure present right here, right? So still there is some liquidity present towards the left side. So how should you approach entries in this order block? The same thing we did right here. Just increase the risk a little bit, but not up to 1%. You can take 0.6% risk here or even 0.5. This is completely subjective. This is completely up to your own subjective strategy, customization, whatever you want, you can do. But I would suggest 0.5 or 0.6 is completely fine. Okay. All right. So let's write 0.5 right here. So guys, this is how you should approach liquidity, right? It's nothing but structures present towards the left side of the market. If you understand this concept properly, you can master SMC within at least 1 year. Like usually mastering SMC takes more than 2 years, but I would suggest it takes less than 1 year if you understand the concept of liquidity very, very concretely. Okay. So now let's say the market comes down here. Now the market should have already taken liquidity present here and liquidity present here. It also failed these two order blocks. So it's a no-brainer. The probability that the market will go up or at least give us a small reaction here is very, very high. So these are the points you should not miss. So obviously you can blindly just take 0.1% risk in this order block. Don't forget that you should take entries only in your point of interest. So only take entry in order blocks, right? You should not trade the gaps between unless and until you get a strong church in lower time frames. Let's say 15 minutes. Okay. So guys, this is the simple, I can't explain this even simpler than this. This is the simple way on how you should approach liquidity. Just look for liquidity. Sometimes it happens on the right side. Sometimes it's already present on the left side. All you have to do is adapt to your entries by looking at the liquidity in accordance with the liquidity that's present in the structure. Okay. So this is the simple way. Now let's look at a different scenario. This is a different scenario. As you can see, the breakout structure happened right here, a strong and valid breakout structure. So this will be our confirmed swing low. So what should we do next? We should take out fib, find the 0.5 level, whether the market gave us a 0.5 pullback. So the market did not give us a 0.5 pullback from here, right? So any breakout structure that happened right here is not strong. So we won't be considering that. And then the market just after a small break goes up. We get a confirmation that this is the swing high because we get a very strong pullback towards the downside. So all things are done and set. So now how should we approach liquidity in this structure? So this is the swing high, this is the swing low. So we got two order blocks present here. After breaking this high, this order block formed. After breaking this breakout structure, we get this second order block. Okay. So when the market comes down, you should ask yourself whether it hunted any liquidity while the market was coming down. In this scenario, the answer is no, because the market didn't have any liquidity towards the left side. The market did not create any liquidity towards the right side, right? So the market is about to mitigate this order block without hunting any liquidity. So the chances that this order block fails is very, very high. So what should you do? The simple step we did previously, just modify your risk management for this order block. Let's say you take 1% per trade. Let's say you just risk half of that, 0.5. This is the simple and this is the only thing you can do, right? You can do anything more than this. You can look for confirmations, different entry models. Like I said, that's advanced. But this is completely fine. Just modify your risk and you will be better off trading SMC. Okay, so you can take 0.5 in this order block. So the chances that the market will break this order block and hunt this liquidity is very, very high because this liquidity is pretty strong. It happened with after a range, right? So always when such ranges happen, liquidity present below or above them is very, very strong. So usually when the market comes down, hunts the liquidity and mitigates this order block. Now you're completely free to take 1% trade, because there is no more for the market to go. The market has already hunted every liquidity present in the structure, right? So now you can take 1% per trade. So guys, this is how you should approach this scenario. Now let's just look at a slightly different scenario to show you guys how a small breakout structure will change your entire perspective of the market. Let's say instead of BOS happening right here, Let's say BOS happened right here. Okay. So this is just a small shift in the scenario, but this has some huge impact, because always when we get a very strong breakout structure, that means only a strong order block could break this, right? So in the previous case, the strong order block was the second order block, but in this case, this is the strong order block. The first OB is the strong order block, which gave us a breakout structure. So in this case, even when there is liquidity present below this order block, the chances that the market will react to this order block is actually very high, right? So what can you do? The simple step we always do, just increase your risk per trade in this order block. So instead of taking 0.5, you can take 0.7 or 0.8, it's completely up to you, but the point is to increase your risk, because this order block is pretty significant than the last scenario, right? Okay, so this is all you can do, guys. Like I said, it's about adapting to every single structure you get in the market. There are no rules, there are no protocols you need to follow. You should always adapt. And what are we using to adapt to the markets? We are using only one thing, liquidity, right? So the same thing once again, when the market comes down, you can obviously take 1% risk in this order block because the market has hunted every single liquidity present towards the left side. Okay, so now let's look at a different scenario. All right, so this is a very interesting structure, a very interesting scenario. So if you see here, we got only one strong and valid order block in this entire structure, and this order block led to the breakout structure. This is a very valid and strong breakout structure. So the market is an uptrend, obviously. So when the market is coming down, is there any liquidity present towards the left side of the market? The answer is no, right? There's no liquidity present towards the left side of the market. But usually when the market has to go anywhere, it needs to hunt liquidity. That's the nature of the market. It always hunts liquidity, traps traders, retail traders, institutions. It traps everyone. It always looks for the cheapest trade so that the market can move from point A to point B. That's the basis. So in this case, we got no liquidity present anywhere in this entire structure. So this is the point where it gets slightly complicated. But I'm sure if you just practice what I'm about to say, you'll get the hang of it very quickly. Okay. So when there is no liquidity present towards the left side of the market, which is here, sometimes what tends to happen is the market creates its own liquidity towards the right side of the market. So this is the point where the market gives all kinds of wild movements to the right side. Multiple retail SLs have been hunted. The market does anything it wants to do in order to accumulate liquidity, right? So we cannot be sure what the market will do in this scenario. Sometimes it will come very close as if it's about to mitigate our order block, and then it will just go up. Take every stops here, and then once again the market will come down and mitigate this order block. So all these wild movements, unexplainable movements which happens in the market usually happens within this scenario, because there is no liquidity present anywhere in the structure, right? So sometimes the market does this, it just does this about it. It's like it's about to move up. It forms a trend line, something like this. It breaks every single SL, every single structure here, accumulates huge amount of liquidity, mitigates this OB, and then the market continues its uptrend from here. So all kinds of wild things happen here, right? So how should you approach these kind of scenarios when you're trading? The simple answer is don't take any trades unless and until the market mitigates your point of interest, which is your order block. Like I said, anything can happen here. The market can do anything. It can come like this, hunt every SL right there, and then mitigate this. So anything can happen in this particular scenario, right? So by now you would have understand that you should always adapt to the markets using liquidity, how it's placed within every single structure. So it doesn't matter which time frame you trade. You can trade any time frames. When you trade SMC, always you should adapt and change your approach in accordance to the liquidity that's accumulated within that structure. How it's accumulated, where it's accumulated, how much it's accumulated. So you should always look at all these parameters before adapting, right? So without adapting, you will always be trading against the market, which will obviously give you more losses than winning trades. So always look for liquidity in every single structure and adapt to the markets. So guys, this is the simplest explanation I could make within one single video. Hope you understood how you should approach liquidity in SMC. If you have any doubts, put them in the comments. See you guys in the next one.